Welcome. In today's explainer, we are going to tackle a really cool tool. It basically acts like a translator for the market's, well, it's often chaotic language. It's called the average true range, and it helps us measure that one thing that really defines all the market drama, volatility. You know, it helps to think of the market like it has its own personality, right? Some days, it's just chill, predictable. It moves along without much of a fuss. But then you have those other days where it is just wild, super energetic, and you have no idea what it's going to do next. So that's the big question for us today. How in the world do you measure a mood like that? So on one side, you've got your calm market, just small, pretty steady price moves. And on the other side, you've got a volatile market. We're talking big, unpredictable swings that can feel like you're on a roller coaster. This right here, this measure of the market's energy, the size of its swings, is what traders call volatility. And it's exactly what we need a tool to get a handle on. So, let's meet the tool for the job. It's called the average true range, or just ATR for short. And you can pretty much think of it as a ruler for measuring that market mood we were just talking about.
So what is this thing exactly? Well, the average true range, or ATR, is a technical indicator that does one thing really well. It measures market volatility. It was actually developed way back in 1978 by a market legend named J. Wells Wilder Jr., and believe me, it has been a fundamental part of a trader's toolkit ever since.
The absolute easiest way to think about the ATR is with this analogy. It's a volatility ruler. That's it. When the number on the ruler is high, it just means the market is making big, energetic moves. You've got high volatility. And when the reading is low, the market's quiet, making smaller moves. Low volatility. Simple as that. And this timeline really shows you its staying power. I mean, Wilder first created the ATR specifically for the commodities market, things like oil and grain, which was famous for being super volatile. But the idea was so good, so universal, that now it's used absolutely everywhere, from the biggest tech stocks to entire global markets.
Okay, so how does this ruler actually, measure anything? Let's pop the hood and take a look. And don't worry, we're not going to get bogged down in a bunch of complicated math. We're just going to focus on the really simple, kind of brilliant idea that makes it all work.
The secret sauce to the ATR is this concept called the true range. And the whole point of the true range is to capture the entire story of a single day's price movement, its biggest, most complete stretch from the very top to the very bottom.
Now here's the clever part. The true range doesn't just measure the distance between today's high and low. It also looks at how far today's price moved from yesterday's closing price. This is so important because markets can gap open, meaning the price today might start way different from where it ended yesterday. The true range actually captures that hidden volatility, giving us the full picture.
And from there, the logic is really straightforward. First, you find that true range, that full price stretch for each day. Then you just calculate the average of those daily ranges over a certain amount of time, usually about 14 days. And that final number you get, that's it. That's your average true range.
Okay, great. So we've got our measurement. We know how volatile the market is. But the big question is, so what? How does this little ruler actually help traders make smarter decisions?
Well, it turns out to be incredibly practical. Traders use the ATR all the time to set smarter stop-loss levels, to manage their risk, to get a feel for the real strength behind a price move, and even to help decide how big of a trade to put on. Probably the most common use is for setting stop-losses. Think of a stock with a high ATR like a roller coaster. It's just built for big ups and big downs. If you set your safety bar, your stop-loss, way too tight, you're going to get tossed out on a perfectly normal dip. The ATR gives you a sense of how big those dips usually are, so you can give your trade enough room to breathe. The ATR also works great as a confirmation tool. So imagine a stock price is just soaring. If the ATR is also rising at the same time, it suggests that the volatility, the energy, is picking up right along with the price. That can be a really good sign that there's real momentum, real conviction behind that trend. But of course, no tool is perfect. It's just as important to understand what the ATR can't do. And it has one very big limitation that you absolutely have to respect. And here it is, the single most important thing to remember. The ATR is a ruler, not a compass. It tells you how much the price is moving, but it tells you absolutely nothing about which direction it's headed. A high ATR could mean a stock is soaring, or it could mean it's crashing. All it measures is the intensity of the move, never the direction. And yeah, there are a few other things to keep in mind.
You know, like a lot of indicators, it's a lagging one, because it's based on past data. You also can't really compare the ATR of a $500 stock to a $10 stock without some context. And most importantly, it's a helper tool. It's not meant to be a standalone buy or sell signal.
So after all that, what it is, how it works, and what it can't do, what's the big takeaway here? What's the new perspective the ATR gives us?
I think this quote really gets to the heart of it. ATR is a nice chart analysis tool for keeping an eye on volatility, which is a variable that is always important. See, it's not about predicting anything. It's just about paying attention to one of the market's most powerful forces.
And that's really the core of it all. The ATR doesn't predict the future. It provides perspective. By giving you a clear, simple measure of a stock's typical behavior, its personality, it helps you make smarter, more context-aware, and ultimately more risk-aware decisions.
So we'll just leave you with this question to think about. Before, the market's mood might have seemed totally random and chaotic, but now that you know there's a ruler to measure it, how is that going to change the way you see the market?